Hi, welcome to the wonderful world of banking and finance. I am Srinivasan. Let's have a peek into what happened in the banking sector during the week that was. Happenings in this sector creates a lot of buzz, and the buzz is usually a mixed bag, like a curate's egg, good in parts. The Reserve Bank of India, for a large parts, monopolized the news. Surprised, right? That this stodgy institution can make waves. But ever since the economic slowdown, RBI had to increasingly take the driver's seat to coax life into the economy. And with the advent of COVID-19 pandemic and subsequent lockdown, RBI was forced to get into the T20 format of economic policy making. So last week was again all about RBI and its policy actions. We saw a lot of action by the RBI. Mr. Shaktikanta Das, the central bank's governor, is truly on the hot seat, and no sane Indian would like to trade places with him. The economy is stalling, the lockdown has been painful, supply chains have been severely disrupted, MSME have particularly suffered in spite of infusing liquidity, credit allocation by banks to needy NBFCs, and other sectors are not happening. There is mounting pressure. He is employing every possible trick in the books available to him to kickstart the economy, or at least trying every possible monetary fencing to get the economy moving. Yes, there are innumerable variables, and we can just hope RBI's efforts pay off, both in the short term and the long term, but more in the short term because the pains are here more on the short term basis. So let us see what different pieces of news hit the bank street. So here we go. The top news is arranged in no particular order. The news first which came was NHB opens new lending window through 10,000 crore special refinance facility to boost liquidity. Fitch downgrade viability ratings of four banks. RBI extends SLF MF scheme to all banks to ease liquidity pressure. Amended trading hours in financial markets to continue till further notice, says RBI. Axis Bank plans to raise 35,000 crores. Banks park over 7 lakh crore with RBI via reverse repo. RBI may raise promoter holding cap in private banks. All payments via cards can now be contact free. And now let's go into the details. So NHB opens new lending window through which rupees 10,000 crore special refinance facility is going to be offered to boost the liquidity. Now NHB, as we know, is National Housing Bank, the apex housing financial institution under the aegis of RBI. Now it has come out with a refinance pack. This refinance of 10,000 crore is of a 1 year tenor for all housing finance companies. Now, the eligibility clauses for tapping this SRF includes HFCs, that is the housing finance companies' ratio of individual housing loans to total assets, which are of course loans for the HFCs, should be a minimum of 51%. Their net non-performing assets cannot exceed 7.50%. They should have extended moratorium to their customers, and this should have adversely impacted at least 15% of their cash flows during the moratorium period. That is from March 1st to March 31st, 2020. There are other riders as well. SRF to be used for individual housing loans under priority sector only. Now, the housing loans to be classified under priority sector has amount restrictions. So banks may not have much of an elbow room here. Loans to individuals up to 35 lakhs in metropolitan centers and rupees 25 lakh in other centers, provided the overall cost of dwelling unit in the metropolitan centers and at other centers does not exceed 45 lakhs and 30 lakhs respectively. Another important thing is the utilization of the funds. The utilization of the funds drawn from SRF need to be consumed within the 12-month period. And the consumption is also graded. Consumption in the sense the utilization of the loan. You must utilize 25% within the first 3 months, and then 50% within the next 6 months, and then 75% within the next 9 months, and 100% in 12 months' time. So, will the banks opt for this window? Yes and no. I'm not very optimistic, uh, given the state of our housing sector and the real estate and the supply and demand disruptions due to lockdown. Perhaps the infusion may partially mitigate HFC's liquidity risk and improve the overall liquidity in the housing finance sector. The second news is Fitch downgrade viability ratings of 4 banks. Now, Fitch is a global rating agency, and Fitch has downgraded by a notch, in fact, by 1 notch, the viability ratings of 4 large banks: State Bank of India, ICICI Bank, Axis Bank, Bank of Baroda. Fitch, in a statement, said that viability ratings of these 4 banks have been downgraded. For SBI, ICICI, and Axis Bank, it has been downgraded from BB plus to BB. The viability ratings of Bank of Baroda has been downgraded from BB to BB minus. Now the question is, what are viability ratings? Simply said, viability ratings measure the intrinsic creditworthiness of a financial institution and reflect the likelihood that an entity will fail. That's it. So it is actually a red flag for the markets. Now, another important thing that we need to know is, what are these BB ratings? Now, BB ratings indicate an elevated vulnerability to default risk, particularly in the event of adverse changes in the business or economic conditions over time. And today, of course, we are facing a lot of headwinds because of this corona pandemic. So what happens in case of a downgrade? The prices of that entity goes down. In other words, borrowing costs go up, thus impacting the bottom line. In another news, RBI extends SLF MF scheme to all banks to ease liquidity pressure. Perhaps the potential contagion effect of Franklin Templeton's closure of their debt fund must have prompted RBI to go on front foot. The move perhaps is to stanch liquidity strains on MF due to redemption pressures. So the RBI opened the SLF MF facility of rupees 50,000 crores with a view to ease the liquidity pressure facing the MFs, that is the mutual funds. This facility is available till May 11th, 2020, or up to the utilization of the allocated amount, whichever is earlier. Now, when we talk about banks utilizing this facility, we mean when banks extend loans or undertake outright purchase or repo against collateral of investment grade corporate bonds or commercial papers or debentures or certificate of deposits. All these things would come under this particular liquidity window. And not only that, the banks would be eligible to claim regulatory benefits. Now, it's very important for us to know what regulatory benefit really means to the bank. So, regulatory benefit means, in the first place, liquidity support availed under this scheme would be eligible to be classified as held to maturity or HTM, even in excess of 25% of the total investment permitted. Two, exposure under this facility will not be reckoned under the large exposure framework. Thirdly, the face value of the securities acquired under the SLF MF scheme and kept in HTM category will not be reckoned for computation of adjusted non-food bank credit for the purpose of determining the priority sector targets and subtargets. And lastly, extended support extended to mutual funds under the SLF MF shall be exempted from banks' capital market exposure limits. Amended trading hours in the financial markets to continue till further notice, says RBI. The Reserve Bank of India on Thursday, that is last Thursday, said the amended trading hours for the financial markets regulated by it will continue till further notice. On April 3rd, the Reserve Bank of India first announced curtailment of trading hours for financial markets across board for 4 hours, to 4 hours from 10 a.m. to 2 p.m. That is from April 7th to April 17th because of this COVID-19 outbreak. And later on, it had it extended up to April 30th. And now it says that this amended trading hours, that is between 10 a.m. to 2 p.m., would continue till further notice. Axis Bank plans to raise rupees 35,000 crores. Lenders usually go in for propping up their capital to either take care of potential loan loss or for business expansion. Pretty simple. Both the reasons are true for Axis Bank. Axis Bank plans to raise almost 35,000 crores, an equivalent of $4.6 billion, due to additional provisions that it has to make because of default stemming from coronavirus outbreak. The Mumbai-based lenders' provision surged 185% to 7,730 crore for the quarter ended March 31st from a year earlier. Massive amount. And of this, 3,000 crore are for COVID-19 related exposures. The bank's board have approved fundraising, which will take place through sale of bonds. So Axis now joins Kotak Mahindra Bank in seeking additional funds, readying perhaps for the loan loss due to rare economic contraction in India. Banks parked over 7 lakh crore with RBI via reverse repo. Banks parked almost 7.05 lakh crore via reverse repo with the central bank, according to India Ratings. While a majority of it is kept at fixed rate of 3.75%, the rest is through variable reverse repo. The funds that RBI gave, both through a cut in cash reserve ratio and additional liquidity measure, are finding their way back into RBI through reverse repo. The lenders are absolutely comfortable keeping funds at the safest possible option, even though the returns are meager compared to what they might have earned from lending to a corporate. Banks may raise promoter holding cap in private banks. Current rules on holdings in a bank stipulate that promoter shareholding in private banks cannot exceed 15%, with voting rights capped at 15 to 20%. The Reserve Bank of India, it seems, is looking to raise this ceiling and is now actively framing new rules. Perhaps the Reserve Bank of India believes in having a level playing field in the private banking space after its decision on Kotak Mahindra Bank promoters shareholding case. Now hear out this story. In January, the Reserve Bank of India allowed Uday Kotak, Asia's richest banker, to hold 26% stake in Kotak Mahindra Bank as long as Kotak Mahindra Bank didn't raise capital through a share sale. The promoters' voting rights were restricted to 15% from April. The rules also stipulated that Uday Kotak will not be allowed to top up his stake if it falls below 26%. KMB, that is Kotak Mahindra Bank, recently announced a fundraising plan of nearly 7,500 crore that will allow Uday Kotak to bring down his stake by a percentage point. Kotak has time until September to prune his 30% holding to 26% holding. Post the Kotak decision, IndusInd Bank promoters, the Hinduja brothers, wrote to RBI in early March, seeking nod to raise their stake to 26%, citing the relaxation granted to Kotak Mahindra. And the last top news of the day of this week is all payments via cards can now be contact free. Now, the Reserve Bank of India has given a green signal to countries' payment networks, Visa, MasterCard, and the NPCI, to allow tap and go functionality on their card payments for all their purchases at the retail store and at the shopping centers. The card present transaction with EMV chip and PIN cards may be processed into contactless mode irrespective of the transaction value, the Reserve Bank of India notification said. The tap and go card payment for purchases above 2,000 will require two-factor authentication, and customers must enter a PIN to process the transaction. This move is aimed at making such transactions safer and contact free during and after the coronavirus pandemic. Tap and go transactions are enabled by radio frequency identification technology, and they don't require physical contact with the payment terminal. The EMV chip that we spoke about is the latest technology and is the latest global standard for card payments. EMV is an acronym for Europay, MasterCard, and Visa, who developed this technology. EMV cards are chip based payment cards with enhanced safety features that are designed to prevent fraudulent practices such as card skimming and cloning. Well, friends, that is all for the news. That's all from us this week. See you all next week with another installment of a banking bulletin. Till then, take care and stay safe and stay positive. Goodbye.